some questions. The wonderful Sophie Wade chimes in and she says, I'd love to hear your thoughts about the signals coming from the market anticipating loan defaults. What are your thoughts?
Yeah, so interestingly and happily for me, I was looking at this just early today, and our data show that we've got about 50 billion in CMBS maturities coming up by the end of 25. Now, CMBS is a relatively small slice of the market, but I think it's generally indicative. It is a lot of those kind of major market, central business district, multi-tenanted buildings. So it's kind of, I think, what a lot of us have in mind when we think office building. The delinquency rate has certainly gone up. It was 8%, maybe 7.5% or so as of January. It's coming up into the 8s now, which is now higher than it was right in the throes of the early part of the pandemic. So I think that's an indicator. As those loans mature, not just CMBS, but as loans mature, that's where you're triggering liquidity events, right? But at the same time, we have, I think, a lot more of those that are being extended than perhaps we anticipated 6 to 9 months ago. Some for contractual reasons. A lot of the short-term CMBS loans originated in 21, 22 had those provisions in them. And some for workout reasons. If you do have reasonably stable occupancy and the tenant's paying and you can make your debt service or get close to it, even if the LTV is a little bit off, there's a lot of that kind of workout behavior happening. So I don't think it's going to be, the wall of maturity that triggers this immediate price crash. I do think that it is a factor that's going to help liquidity improve and then reset prices over the next, I think we're calling the trough right now around the end of 25. So over the next, 20 months or so.